Welcome back to the Deep Dive. Today, we are stripping away the headlines and looking at the invisible architecture that pretty much holds up the entire global economy.
We're talking about the U.S. dollar.
Exactly. And to kick this off, I want to try an analogy on you. Picture the dollar like a very specific type of friend.
Okay, I'm listening.
You know the guy? For 20 years, he was the king of the bar. Always grabbed the check, always had cash. Stable.
Maybe a little arrogant, but reliable.
Totally reliable. But lately, it feels like that same friend is tapping you on the shoulder at 11 p.m., asking if you can cover the tab this time.
Or maybe asking for a short-term loan.
Right, because his cards are maxed out. That's a surprisingly vivid image. And unfortunately, given that today is January 34, 2026, it is uncomfortably accurate.
It really feels like the dynamic has shifted, doesn't it?
It does. If you've been watching the news this January, the greenback has had a brutal start to the year.
It really has. We're looking at a stack of sources today. Reuters, market reports from JP Morgan, and they are all painting a picture that looks less like a standard market correction.
And more like a regime change.
It's a convergence. I think that's really the best word for it.
Convergence of what?
Well, usually, currency moves are kind of boring, 1% here, 1% there. But right now we're looking at the DXY.
That's the index that measures the dollar's strength against other big currencies.
Exactly. And it is hovering right around 97, specifically between 96.99 and 97.15.
Okay, which, for listeners who don't spend their days staring at a Bloomberg terminal, we need context for that.
Yeah.
97 doesn't sound like zero. Is that panic territory?
It's not zero, no, but context is everything. Earlier this week, it touched a 4-year low of 95.55.
A 4-year low. Wow.
And if you zoom out, the dollar has lost over 10% of its value in just the last 12 months. That includes that mega drop we saw back in 2025.
So this isn't a fluctuation. It's a trend line pointing straight down.
Strictly down. And that's where the disconnect in the sources gets so interesting.
You mean with former President Trump on the trail saying the dollar is great, beautiful, never been better?
Right, but then you look at the trading floors and the market seemed to be voting for something else entirely.
One of our sources explicitly said the market is voting for chaos.
That is the operative word today, chaos. We're breaking down a report titled 8 Reasons the Dollar is Falling in 2026.
And our mission is to figure out why King Dollar is looking, well, dethroned. We need to separate the political noise from the economic math.
And ultimately, this is the part that hurts. Figure out why your next vacation or even just your grocery bill is about to get a lot more expensive.
So let's get into the machinery of this. The report groups these 8 reasons into buckets. And the first one is exactly what you just said, the chaos factor.
Politics versus the Federal Reserve.
This is reason number 1, the erosion of independence.
This is arguably the most dangerous factor because it changes the rules of the game.
Oh.
The Federal Reserve is supposed to be the referee. They manage inflation, employment. They are specifically designed to be independent of the White House.
So they don't just print money to help a president win an election.
Exactly. Their job is to take away the punch bowl just when the party gets fun, as the old saying goes.
But the sources here are describing a referee that is being tackled by the players.
That's a polite way to put it. We're seeing brutal political pressure. You have Trump attacking the Fed, demanding aggressive interest rate cuts, regardless of the inflation data.
I feel like I see a notification about this every other day. There are reports of him investigating or even threatening the current chair, Jerome Powell.
And he's not just threatening Powell, he's floating replacements, right? Names like Kevin Warsh.
The so-called friendly candidates.
Right. But friendly to a politician often means dangerous to an investor. Robin Brooks, who used to be at Brookings and ING, he describes this as the chaos of erratic policies.
Okay, but why does that specific political drama crash the dollar? Is it just bad vibes, or is there a real mechanism there?
Oh, it's a mechanism. It's all about predictability.
Stability.
Yes. Investors crave stability. If I'm a Japanese pension fund and I hold billions in US dollars, I need to know the Fed is making decisions based on math, not a tweet.
And if it looks like policy is being dictated by politics.
Investors get nervous. And in the global currency market, when you get nervous, you sell.
Which flows right into reason number 8 in our stack, the Sell America trade. It sounds like a bumper sticker, but the numbers here are pretty stark.
Well, it reflects a fraying of the narrative. The CNBC had a fascinating analysis on this.
What'd they say?
They pointed out that the underlying economic fundamentals of the U.S., how many widgets we make, how many people have jobs, they might actually be okay.
Not perfect, but okay.
Right. But the story of the U.S. economy is broken.
Because of the chaos.
Exactly. If the policy environment is erratic, you move your capital somewhere else. We saw it this week. The sources note we just had the worst single trading day since April 2025.
That is not a glitch.
No, that is institutional money pulling the ripcord because they do not like the uncertainty.
So, political chaos is shaking the foundation. That's the sentiment. But then we have the cold hard accounting.
The fiscal cliff.
Right. Reason number 4 is the deficit and debt. I feel like we talk about the deficit every year and people just tune it out. It's just a big, scary number that never seems to affect daily life. Why is this time different?
Because of the scale. We're looking at an explosive fiscal deficit now greater than $2 trillion a year.
$2 trillion, with a T, every single year.
Every single year. And it's driven by a combination of tax cuts and high spending. JP Morgan and Morningstar are highlighting this as a major red flag.
They're calling it fiscal worries.
Which is a very polite term for it. Really, it's a credit check. When you have a big, beautiful bill, as it's sometimes framed, investors start to worry that the only way the U.S. can pay its debts is by
printing more money.
Which devalues the money that already exists. That's inflation, basically.
So there's a real fear of inflation reigniting or even a credit rating loss.
Precisely. When you borrow that much money, eventually your lenders start asking if you're actually good for it. And that erodes the quality of the dollar as an asset.
Okay, so we're spending money we don't have. And we're also changing how we interact with the world commercially. Reason number 3, tariffs and trade.
Reciprocal tariffs and Trump 2.0 protectionism.
Now, I'll play devil's advocate here. I thought tariffs were supposed to strengthen a currency. Buy American, reduce the trade deficit.
In a textbook vacuum. Sometimes, but in reality, and certainly in 2026, no. The sources break this down really well.
So how does America first lead to a weaker dollar?
Well, think about what the dollar actually is. It is the lubricant of global trade.
Right, it's used to buy and sell goods everywhere. Oil, electronics.
Everything. So if the U.S. becomes isolationist, if we put up walls, trade volume just drops. Or even worse, other countries start trading around us to avoid the tariffs.
And if they aren't trading with us, or they're actively avoiding our system?
They don't need to hold as many dollars. It reduces the structural demand for the currency. Reports from the BBC and CBS point this out. A closed-off U.S. slows the velocity of money globally.
So if you're not the buyer of last resort anymore, people don't need to keep a stack of your cash in their wallet.
Exactly. Utility drives value.
Let's pivot to the technical side then, the levers the Fed is actually pulling. Reason number 2, interest rates.
This is the monetary mechanics chapter, and it's pure math.
Okay, lay it on us.
We have to look at the cycle. The Fed started cutting rates back in 2025, and the expectation is they will cut again maybe in June or October of this year.
And for anyone who hasn't looked at a bond yield curve lately, why does a rate cut make the dollar fall?
Think of interest rates as the yield. It's the reward you get for holding dollars. If you buy U.S. Treasuries, the government pays you interest.
So when the Fed cuts rates, that reward gets smaller.
It's like a savings account lowering its interest rate. If the bank across the street, let's call it the Bank of Europe, offers a better rate.
You move your money across the street.
Perfect analogy. And according to Trading Economics and FX Pro, something like 30 to 40% of the pressure on the dollar right now is coming purely from this factor. It's not emotional, it's algorithmic.
But that implies there is a bank across the street worth going to. Which brings us to reason number 6, global growth.
Yes. For a long time, the narrative was the U.S. is the cleanest shirt in the dirty laundry basket.
Right, even if we had problems, everyone else was worse.
That narrative has expired. The sources show that Europe and emerging Asia are actually rebounding. The Japanese yen is strengthening significantly.
So the rest of the world is getting their act together while we're stumbling.
That's a good way to put it. Currencies are a relative game. The dollar is only strong if it's stronger than the euro or the yen.
So if the rest of the world grows faster, our relative value drops.
And that's what's happening. ING is predicting another 4 to 5% drop in 2026 just because of this. The U.S. isn't the only growth story in town anymore.
Okay, that leads us to the section that feels less like economics and more like a spy novel, the crisis of confidence.
Reason number 5, geopolitics and safe havens. This is geopolitics in chaos mode.
The report lists some tensions that are, frankly, bizarre. Renewed friction with European allies, but also Threats regarding Greenland.
Greenland, again.
We are trying to buy the island again.
Apparently the idea hasn't died. And while it sounds almost funny in the diplomatic world, it just signals unpredictability. It adds to the perception of instability.
So when investors get scared, they look for safe havens, which used to be the U.S. dollar.
But if the U.S. is the source of the scare...
You can't run to the burning house for safety.
Exactly. So they're looking elsewhere.
And where are they looking? Where do you put $1 billion if you don't trust the dollar?
Gold. Look at the numbers. Gold is coquetting with $5,000 an ounce.
5,000. That is staggering. I remember when 2,000 felt expensive.
It's historic. The Guardian calls this a crisis of confidence. When you see gold at $5,000, that isn't just about inflation. That is about pure fear.
It's investors saying, I don't trust the politics. I don't trust the paper money. I'm buying a literal bar of metal.
And we're also seeing flows into the Swiss franc and the euro.
That gold price feels like a siren going off. But there's a deeper, more structural shift happening too, isn't there? Reason number 7, de-dollarization.
This is the long-term threat.
This isn't just investors fleeing. It is entire countries opting out.
Right. We're seeing the BRICS nations, Brazil, Russia, India, China, actively diversifying their reserves away from the dollar. They are trying to build a financial plumbing system that isn't dependent on Washington.
But we've heard about this for years. Is it actually happening, or is it just summits and handshakes?
We have hard numbers now. The data shows net capital outflows from U.S. treasuries and equities were between $18 and $22 billion. In January alone.
In 1 month. Wow.
That's a massive exit. Trading Key and JP Morgan are tracking this flow of funds into emerging markets. It's a clear signal.
They aren't dumping the dollar entirely, but they are hedging their bets.
They're moving a chunk of their savings into other baskets, for sure.
So let's recap the scorecard. We have political chaos, falling interest rates, massive debt, trade wars, global competition, and a total loss of trust. It is a perfect storm.
It really is.
But here's where I want to ground this. We've been talking about billions and trillions. What about the person listening on their commute? So what? Does a weak dollar actually matter to normal people?
It matters immensely, but it's a double-edged sword. It's not purely bad for everyone.
Oh.
If you're a U.S. manufacturer, say, you make heavy machinery in Ohio and you want to sell it in France, a weak dollar is great. It makes your machine cheaper for them to buy.
Okay, so U.S. exports get a boost. That's the silver lining.
It is. It also technically makes the massive U.S. debt a little easier to pay off because you're paying it back with cheaper dollars. But let's look at the clouds. The source material uses Colombia as a really interesting case study.
Yeah, walk us through that. If I'm in Bogota looking north, what do I see?
Well, the good news is imports from the U.S., like technology, computers, fuel, they get cheaper for you. And if the Colombian government has debt in dollars, that burden gets lighter.
But there's a bad side.
A significant one. Remittances.
The money sent home by workers in the U.S.
Correct. Millions of families rely on that. If a worker in Miami sends $100 home to Colombia and the dollar is weak, that $100 buys significantly less rice, less rent, less healthcare.
It's a direct hit to household income in emerging markets.
A huge hit. And what about the Colombian coffee grower? They suffer too.
How?
If they sell coffee to Americans, the Americans are paying with weaker dollars, so the coffee becomes more expensive for the American consumer, and maybe they buy less.
Which brings it right back to us. The American consumer. Imported inflation.
This is where it hits your wallet. Everything the U.S. buys from abroad, electronics, cars, avocados, wine, it costs more dollars to buy.
So prices kick up at the store, not because the product changed, but because your money is worth less.
Exactly. And I assume travel is the other big one.
Oh, absolutely. If you're planning that trip to Paris or Tokyo this summer, brace yourself.
Your dollar's going to buy you a lot less.
The hotel is more expensive. The dinner's more expensive. It's a reduction in your standard of living relative to the rest of the world.
That is the sobering reality. It's not just lines on a chart. It's your purchasing power.
So wrapping this up, this feels heavier than a standard economic slump.
It's different because of the root cause. As Reuters put it, markets hate chaos more than a predictable recession.
You can plan for a recession.
Right. Companies have playbooks for that. You cannot plan for erratic policy shifts, for attacks on institutions, for geopolitical weirdness. This is a loss of political and fiscal confidence.
And looking forward, if this chaos continues, Where are we heading for the rest of 2026?
Most analysts see the DXY staying low in that 95 to 98 range throughout the year.
So unless something changes.
Unless the Fed regains its perceived independence or the geopolitical temperature cools way down, the dollar is going to struggle to find its footing.
We need to get comfortable with a cheaper dollar.
Yeah.
I want to leave our listeners with the questions posed by our source material today. Is this the definitive decline of the dollar, the end of the empire, so to speak? Or is it just a stumble before a rebound?
If the Fed stands its ground, could the king return?
That's the question.
And I would add one more. That $5,000 gold price. Is that a bubble waiting to burst? Or is it the new standard of value in a world that has lost faith in paper money?
Heavy questions to ponder while you check your portfolio. My advice, diversify your thinking and maybe, just maybe, diversify your assets.
We will be watching these numbers closely. Thanks for diving in with us.
Always a pleasure. Stay tuned for the next deep dive. Take care.